Hi Mark, nice to have you here. I love how you mentioned that expect the unexpected is the defining theme for year 2026 on your current PIMCO perspectives. The questions I prepared for today will build on this outlook. So before we dive into today's market talk, would you please briefly introduce yourself?
Of course, Yvonne, it is an absolute pleasure to be here with you today. My name is Marc Seidner. I am PIMCO's Chief Investment Officer for non-traditional strategies. Oftentimes, people ask, what does non-traditional strategies mean? And in PIMCO's context, it would be liquid, absolute return portfolios, asset allocation, and some more opportunistic strategies. So that's my role.
Thank you very much. So we start today's questions. So let's start with the geopolitics. Over the past 2 to 3 months, we've had an oil shock from the Middle East at the time when the inflation is still trimming toward to the targets and the growth is still very resilient. So how do you think this will affect the growth and the inflation starting from now, and what are the implications?
It's an excellent question. It's probably one of the most important questions we all face as investors these days. You're right, we wrote the piece, Expect the Unexpected, and I think one of the hallmarks we are all facing as investors, you know this as well as I do, is we keep getting hit with these ongoing events that cause volatility, dispersion, and differentiation in markets. With respect to conflict in the Middle East and the ongoing tensions and war between the US and Iran, we don't have a crystal ball or an answer to when conflict will end. What we do know is that this period in time, 2026, is very different than 2022. Coming into 2026, as you said, growth in the United States and indeed globally had been very resilient. Inflation had been moderating and central banks had been normalizing short-term interest rates, lowering short-term interest rates. We would have, earlier this year in January, let's say, we would have suggested that growth for the United States would be in the range of 2.25% to 2.5% for 2026. So a little bit slower than 2024 and 2025, but still very resilient growth. Now, given the conflict in the Middle East, we think that will be in the mid to upper ones, so call it 1.75% growth. So a meaningful revision downward to growth. Inflation, on the other hand, we had expected core inflation to continue to moderate, maybe not to the Federal Reserve's target of 2%, but certainly in the low to mid twos. Our expectation now would be in the mid to upper twos. So there is more of a growth impact from conflict in the Middle East, at least in our base case, than an inflationary impact, but it's certainly a stagflationary environment. Maybe more risk to the stag part than the inflation part, but definitely a stagflationary environment.
Okay, so following on the similar question, I think with the geopolitical tension and also the energy shock, I think this may shift, as you just mentioned, shift us toward to the stagflation path. So the previous energy shock is in 2022, like you mentioned, when Ukraine and Russia have the conflicts. And last time when the war did have a negative impact to both fixed income and equity markets. So this time, do you see any differences or any similarities for this time?
We think 2026 is very different than 2022. And let me be clear what I mean by that. If we think back to 2022, there was a supply shock from Russia's invasion of the Ukraine and the global sanctions that were applied to Russia. But combined with the supply shock in energy, there was a massive demand shock coming out of COVID. You probably remember this. I remember this. We all had increased demand for things, for goods, for services. Employers had excess demand for workers coming out of COVID and the restrictions placed on all of us. And fiscal policy was the fiscal policy impulse around the world was incredibly large. The United States, as an example, in March of 2022, had $1.2 trillion of stimulus in the Inflation Reduction Act. So you had pent-up demand for both goods and services and labor. You had massive fiscal policy stimulus. You had extraordinarily low interest rates around the world. And when combined with the supply shock from energy, that led to a pretty significant inflationary impulse. Today, for sure, in 2026, we absolutely have a supply shock leading to higher energy prices, but the demand side of the equation is very different. Labor markets are in balance, if not weakening, and consumer pent-up demand is largely non-existent, and real incomes are declining, not increasing. And so comparing to 2022, we think the real impact in 2026 will be demand destruction and the risk of declining growth further on into the second half of this year because of rising energy prices. When consumers don't have more income and they have to spend more on energy and gasoline and heating and cooling, then they have less money to spend on everything else.
So now let's move on the credit market. With the recent suspension of redemption in the private credit market, so that's really has drawn the market attention. So I would like to ask your opinion about how that will be developing and where we are in this credit cycle.
Absolutely, one of the market events that was quite pronounced and quite profound in the first quarter was sort of the turmoil in private credit markets. Although we should be clear, private credit is a broad topic and a broad concept. The real turmoil occurred in the suspension of redemptions for publicly traded or non-traded business development companies that had built a business around private direct lending. That's an area that PIMCO has been cautioning about for several years now. There had been incredible growth in that market, large inflows, growth in assets under management, and you and I have seen this before. What happens when there is significant interest in one asset type or one security type, you tend to get a deterioration in analysis and underwriting skills. You tend to get a deterioration in protections for investors, and you tend to get a deterioration in expected return and the risk premia or the yield that you're earning. That's exactly what's happened in private credit. Let me be clear. We don't think this is a systemic event like subprime mortgages in the global financial crisis, but it is certainly going to be an area that can be quite painful for certain investors, quite a challenge for certain companies, and will likely be a dark cloud over the economic outlook and credit creation for many quarters, if not many years to come. So it's an area of concern, not systematic, or not systemic as we saw in the global financial crisis, but certainly will be negative for the growth impulse, credit creation, and certainly quite painful for some investors.
Yeah, so next one, in your 2026 outlook, you mentioned 3 cyclical factors, including like AI disruption, private credit stress, and also the energy shock. Those might reshaping our expectation on rate. So could you please elaborate on that and also give your advice to our fixed income investors?
So you're absolutely right. I mean, the cyclical outlook, and when we say the cyclical outlook, PIMCO tries to build at least 3 or 4 times a year a 6 to 12 month outlook, and our most recent discussions were in March. It happened to be during the week where the conflict in the Middle East just began, so it was a very interesting but also a very challenging time to try to think about the next 6 to 12 months. And we do focus on geopolitics, credit concerns that we just discussed, and AI and technology as being some meaningful events for the balance of 2026. Through all of that, interest rates, while they've moved higher recently, A 10-year Treasury, as an example, that currently yields about 4.6%, has been in a range between 4 and 4.6% for much of the last 3 years. And there's been a lot of news, there's been a lot of disruption, there's been a lot of expecting the unexpected or weathering the unexpected. And despite all of that, 10-year Treasury has been in a quite narrow band. Our sense is that range will likely hold. We might head slightly higher in longer term interest rates, but the 10-year Treasury is in the 4.5 to 4.75% range. Look like a pretty attractive entry point. Treasuries look good. Global diversification looks good, both in terms of developed market government bonds and emerging market government bonds. Let me put it simply. I run a well-diversified liquid alternatives portfolio. It's high quality. So for those that are listening would know it's AA- credit quality, which is very high quality. It has 3 years of interest rate risk, 3 to 4 years of interest rate risk. So right in the sweet spot of the yield curve where interest rates are anchored by central bank policy. And most importantly, it's got 7 to 7.25% yield or expected return. And that's a high quality, intermediate duration, high yield. That to us is a very, very attractive starting point for fixed income and a very compelling starting point for a broader asset allocation.
Okay, so you mentioned that with the good all-in yield, you think it's a good timing for investors to go into fixed income market. So in addition to the US dollar denominated corporate bonds, government bonds, what else fixed income markets you also recommend to the investors?
Let me say one point about asset allocation. If you look at the statistics, and this is true in the United States, it's probably true globally as well, investors tend to be heavily overweight cash and heavily overweight equities. And this middle ground of fixed income is largely being ignored. And just as I said, a 7% type yielding portfolio that's high quality, intermediate duration, that shouldn't be ignored in favor of cash or equities. It should have its rightful place in an investor's asset allocation. You're right, as we said, starting point of a 10-year Treasury looks pretty attractive. You can buy Australian government bonds at half a percentage point higher yield than the United States. Australia is a country that runs largely a balanced budget and has much lower debt to GDP, so much stronger fundamentals or debt and deficit fundamentals than the United States, and we'll take the higher yield. United Kingdom, UK government bonds. There is absolutely a risk premium that's being built into or has been built into UK government bonds. We'll again pick up additional yield by investing in UK government bonds. Emerging markets. Brazil yields 13 or 14%, has 4 or 5% inflation, a 9 or 10% real yield. We love a little bit of Brazil in our portfolios. I could go on and on. South Africa, Peru, Mexico, Colombia, Chile. These are all really interesting opportunities. And even Japan, whose government bond market has not been that interesting for decades now, is presenting some quite compelling opportunities for global investors. The Japanese yield curve is very steep. A 30-year JGB hedged back into US dollars yields north of 6.5%. Again, I want to own a little bit of that. There's plenty of uncertainty, but if we're thinking about an intermediate to longer term opportunity set, there are some very compelling opportunities in global diversification and active management of fixed income portfolios, and that's what we do. That's what we do on a day-to-day basis.
Great. So people in Taiwan, like you just mentioned, we generally have 60 to 70% of our wealth is in the bank deposits, and all others are heavily invested in equity market. So I think we should more often invite you to come to Taiwan to talk about fixed income. Thank you.
Well, it's been a long time since I've been in Taiwan, and I'd be more than happy to come back and visit anytime.
Thank you. Great. So my last question will still be on AI. I think beyond changing human behaviors or productivities, what are AI significantly altering the capital market performance? And what's your advice for investors to reallocate their money in the market in this new paradigm?
AI and the adoption of artificial intelligence and new technology and large language models is absolutely transforming the world. It's transforming investing. It's transforming economies. I mean, here we are in Taiwan, and the growth is spectacular, largely because of technological investment. And it has been viewed as a rising tide that will lift all boats. I think it's highly likely that as AI continues to evolve, there will be increasing winners and losers. Winners and losers in terms of companies, winners and losers in terms of countries, and winners and losers in terms of parts of our population. It's quite certain that AI will increase productivity. It's less certain what that will mean for workers and employment and labor markets, and that will need to be thought of in terms of a longer term trend. What we know about technology, and this is where we focus as investors, is there's, independent of who the winners and who the losers are, one winner for certain will be the need for more computing power, more speed, and more data storage. And that's an area that we've been heavily focused on, financing the build out of data centers for many of our, or for many of the hyperscalers. We have done deals with Meta, we've done deals with Oracle. We get what we think are a good structure, good protections for us as bondholders, and a very attractive spread, an enhanced risk premia over where any of those companies would borrow in public debt markets. And that's an area that we've been focusing on that we think has some very compelling returns, both near term and longer term. And the broader concept would be just the idea of asset-based finance as a way of differentiating in a more uncertain world where you can structure bonds that have attractive protections for bondholders, very attractive spreads and risk premia, and very attractive all-in yields. And so that's another area, in addition to financing AI and the need for data and speed and compute power, an area that we find very compelling in the current environment.
Thank you for coming, and I hope to see you soon again in Taiwan.
You're very welcome, Yvonne. Thank you for your time today.
投资一定有风险，基金投资有赚有赔，申购前应详阅公开说明书。